All right. Hey, everybody. Welcome to the program. We've got a dual program going on tonight. We have linked together the Wealth Circuit Investing and Dapper Dividends, and it is smoking. So
Yeah.
glad to have my buddy Russ on the show tonight. And, he has had quite a weekend. And so I was kind of happy to provide a platform for him to just jump into, because I'm sure he's kind of tired, but we're gonna run you around pretty good tonight. So
Looking forward to it, man. Yeah, I'm usually watching your channel as much as I can on Monday nights anyway. So
awesome.
yeah, I was like, why not? Let's I went to the Indy 500 for the 5th year in a row. I don't believe I went in 2020 because of COVID.
Yeah.
But yeah, it's a good time. My friends, one of my good friends, his aunt is from Indianapolis. So he kind of split time growing up there. Anyway, so we go down there. They invite a bunch of friends, family, the extended family. They become my family. It looks like a tent city in her backyard. Everybody I think there was 9 or 10 tents set up, and it's a good time, man. And go to the race. Are you a race fan? I'm not really a race fan.
I'm not really,
Yeah.
but if I had the opportunity to go, I think I would enjoy it, just the adrenaline of it all. And I think it'd be a cool time.
Yeah, it's fun. So I don't know if any of you are race fans out there, but some things we do in life, it's not so much about the event, but the people that you're hanging out with and people watching and just enjoying the company of others. Like we're enjoying the company of all you watching and you, Kev. So
that's right.
Cheers.
Cheers.
Pat, 2 hours.
Yeah. So I was just highlighting that. So Pat wants us to go 2 hours. I'm not sure we can do that, but we may not stop at an hour either. This depends on what's going on. Depends on how many great questions you guys ask. It really depends on you.
Yeah. So, hey, what are you guys buying? I don't know. Put what you bought or where you're from. I don't know. Oh, by the way, I got to say it, man. I don't know if you remember George Wendt. He passed away. So,
I do.
Last week, 76 years old. But yeah, here in Chicago. He's from Chicago. He's a South Side guy. And obviously one of the super fans, with the Bears. So, hey, maybe he's, I don't know. Anyway, hopefully Norm from Cheers, Bob Swirsky, the super fans, is up there having a cold one and some wings.
There you go. Yeah, one of my favorite lines, and I actually heard it live back it wasn't live, but, on TV back in the day when they actually were on, because I used to watch Cheers as a younger guy. And one of my favorite lines of his was, he busts in the door. Everybody's like, Norm. And he says, it's a dog eat dog world, and I'm wearing milk bone underwear. So.
And I'll top you on that. As tying in with Norm and the beer drinking, one of the flags I saw at Indy, in the infield, there's this huge party goes on. Everyone, cars, RVs, they have a EDM concert, and somebody had a big flag that said it's a bad day to be a beer. A lot of people drinking beer there. So yeah, that's a great quote from Norm. Yeah. I love that.
Yeah. So, man, we got a lot of folks on, and normally I go through and kind of talk about folks, but some of these are your folks, so I may not know them. But let's see. We got Pat's wanting us to be on for 2 hours tonight. And let's see. I think somebody is telling us what they've been buying.
Yep, a couple.
Yeah. So, Janice is buying SCHD tomorrow. That's fantastic. Whiskey Tango Foxtrot. Dow is paying 10%. Wow. Now, is that 10% yield or 10% yield on cost?
Yield. And I'm thinking it's tied to the commodities. I've kind of kept an eye on it, but LyondellBasell, LYB, they raised their dividend 2.2% this week.
I saw that, yeah.
And yeah, their payout ratios are both over 100%. I know you're particular to earnings per share payout ratio. I like the free cash flow payout ratio, but both of them are over 100%, which is no bueno. I don't know if any of you guys watching are buying LyondellBasell. I had invested in Lyondell for a moment, and because they're domiciled in a foreign country, I thought I was getting my foreign exposure. But as I started learning more, and I'm a little bit of a late bloomer, I found out that when you invest in commodity
I've heard that
companies,
about you.
Yeah. I don't wear the bloomers, just the late bloomer. The commodity companies, they're tied to that commodity. They're very cyclical. And the way I heard it, I've put it is like, if you're buying lumber from Home Depot or a company needs steel for a product, unless it's something like highly specialized, do you really care if your lumber comes from Georgia Pacific or Boise Cascade or LCX, the one Buffett had bought? No, you don't care. You're just like, just give me the cheapest 2x4s, right? So that's kind of the good and bad, I think, with commodity companies. So LyondellBasell, Dow, kind of the same thing. They're tied into those petrochemical commodities. And Lyondell filed for bankruptcy in 2008, 9-ish. I think they came out of it in 2010, which is what people can buy now. But yeah, they had their sales dropped off a cliff, their debt was going up, and they had to file for bankruptcy protection. So Chapter 11. Don't know if that'll happen again, but man, I don't know about you. It just doesn't give me a good feeling when you have a company that, a little bit will go file for bankruptcy because of a similar cyclicality that they couldn't handle. So,
yeah, no, when the either payout ratio goes above 100%, it's definitely time to take a look at it, because especially on the cash, especially on the earnings side. On the cash side, it could be related to some kind of capital investment that they made, because free cash flow has to do, it backs out any capital expenditure. So I don't get as alarmed on the cash side if it's over 100%, as long as when I read it, I go, that's a good investment, right? So if they're making a great investment for future dividends, I'm okay with it. But on the earnings side, nah, I don't like it.
And that's a great distinction, because if you remember with PepsiCo, we were talking about them a while ago. I contacted investor relations and they got back to me, and they said it's because we've been investing in the brand and we're positioning ourselves to really grow in the future. So that's why free cash flow has been dropping. So, but but still, either way, if you see that over 100%, it's a huge red flag, and they better have a really damn good reason for it. PepsiCo looks like it could have been. I don't, we'll see how that plays out, but you want to start to see it level off or coming back down.
Yeah, I remember you and I talking about PepsiCo, at some point, gosh, it's been probably 2 years ago, maybe, or more even. And, one of the challenges I had was, as you did, was the high, payout ratio on a cash basis. And so that's, you contacted them, and I just got to the point where I was like, you know what, I think I've got better investments to make. So I sold out of PepsiCo, and then it went up, and then it went back down again. And so it's kind of in a holding pattern, I think.
Yeah. Likewise too, man. I mean, it was just a timing thing. That, remember, I sold PepsiCo at 158. We had 100 shares, and then I think I had like 112 or 14 of J&J. I sold those at like 143.44. So not too good on that one. But and like I've told people, I wrote about it open. We used it to buy our primary car. We upgraded, got an Atlas. It was crazy car prices. It was almost $33K, but I got a lot of flack for that. People saying like, you don't ever sell stocks to buy something. And it's like, look, the account we pulled it out of, our taxable, is like an overflow fund. We put money into that after we've maxed out our 401k, maxed out our Roth, after we've put money in our travel fund, our emergency fund, the kids' 529s. So it's literally like, I don't know, the sixth or maybe even seventh, if you want to count the mortgage, paying the mortgage. So it's like the seventh overflow bucket.
Right.
I'm like, it's okay. We're just like, look, we have extra money, so let's just start seeing what we can do with it. So that's what our taxable account is. And we're like, all right, we're going to give a loan to ourselves. So looked at what stocks we might sell. And crazy though, when I sold PepsiCo at 158, I did not feel good about it. I said, man, this thing was in the 170s recently. And I was like, maybe I'll wait. And I told my wife, I'm like, you know what? No, we need the money. We're just going to sell. We're basically break even, not including any dividends or premium from options. And sold at 158. And I think I saw 128 last week. So it's really taking a beating.
I just looked it up. It's 129.34. I think I sold mine in the 170s as well. So I'm happy about that now that I see this.
One more thing, man, because I was selling calls on it, and I was freaking the heck out, because a couple of times I would sell a covered call like at 185 or 190 strike price. And I remember one day it was flirting with, I think it was 195 I did, and it almost hit 200. And luckily it closed at like 193. And I was like, whew, crisis averted. But, hey, had we known the future, I would have been like, just let it get called away and just, and that's the thing, when nobody knows the future. So,
right. Then we got Rick, who bought some Pepsi this week, and it's probably not a bad buy at this point. I mean, it's 129 is pretty cheap.
So. You're right, man. It's going to get to a point where, I mean, it's like, come on, what are we doing here? I might even get back in if we start seeing the teens. I might just say I can't pass that up. I mean, it's it's not going anywhere.
Yeah, it's hard to pass up a $20 bill when it's laying on the floor. Yeah,
let's just hope it's a real 20. Yeah, and hopefully it's not one of those Hollywood movie $20 bills that blew off a set somewhere, right? That'd be my luck.
Yeah. So Pat here is picking up some Realty Income, Main Street Capital, SCHD, and SCHY. So one of the questions I had as I was kind of thinking about what we could talk about tonight, and what I thought we would do tonight is just have an open discussion. I mean, there's no real theme here. It's just about investing and just what's going on. So I've seen a lot of investors lately, YouTube investors and just dividend investors mainly, shifting over into a lot of ETFs. So do you think that, who weren't there maybe 2 or 3 years ago, right? Do you think that's a trend? And you think folks are, for whatever reason, whether it takes time for, analysis of investing or whatever, do you think folks are kind of morphing toward ETFs versus individual stocks?
Well, I'd love to know the chat's thought on this, but overall, I just read in the Wall Street Journal that VOO, the S&P 500 fund from Vanguard, has already had $65 billion flow into that fund just this year. And I think last year's record was like 115 or 125, somewhere in that area, billion. And it's on pace to smash that. So by and large, the world is just buying more ETFs. There's a lot of mutual funds because they're not getting love. People are just buying the ETFs that they're going to start shifting their mutual fund products to create an ETF version of that so they can still, be in the game. But, for me, it's the easy button. And I've been open talking about it that I've compared a lot of investments I made in individual companies to either the S&P 500 or the VTI, which is almost the total stock market. I know it's called total U.S. stock market, but there's some penny stocks in there that they don't count. And so it's not like, they kind of try and keep most of the riffraff out of that. But it's the easy button. And a lot of my investments on a total return basis that I thought I was super smart making, they failed to outperform. And, I know that's not everybody's game is beating the S&P 500, but I think it's a good benchmark because VOO is so big and so many people use it that it almost to me looks like that's, I don't know, maybe like an opportunity cost benchmark to say, could I have put money into VOO or VTI, which they're really close with the market cap weighted top of them. But, I've also been seeing a trend of, domestic money, like money leaving us domestically and going into international funds. So that's why I've been buying like SCHY. I just started an investment in that. I think I'm up to 25 shares now. And that's the kind of like SCHD, but the international version. And it only has, a little over 100 different holdings. So it's a little more focused. It's not buying just, every international company or something. But so for me, it's the easy button. I mean, what's that stat? 92% of fund managers, professionals, fails to beat the S&P 500 over a 20-year period. That's crazy to me that some of these probably charge 1-2% expense ratios. So, I think it's good to have. That's my core is fund exposure. I want 85% in funds and 15% in individual stocks. Maybe it'll shift, as I get better at this game. One would hope, but it's kind of a protection against, idiot proofing with the idiot clearly being this guy right here. So I work hard for my money. She works hard for the money. And so do I. We both work hard for that money. And I don't want to, piss it away on some stock I thought was great and turned out not to be. But that's just me, my long rant and ramble there. Isn't it nice being on your end? You can just have someone like me and say, what do you think about this? And then just shut up for 5 minutes,
Yeah, I'm not going to lie. I told my wife this morning, I said, tonight's live stream is going to be really easy because all I have to do is like ask a question and Russ will take it from there.
Seriously, I can just, anyway. So what do you think? What is your thought on the ETFs?
So, I mean, I'm just seeing that. I mean, it's anecdotal, right? I mean, it's just like, I hear folks like even like PPC Ian and, as I hear, him update on what he's doing in his portfolio, he's buying a lot of SCHD, which is fine. But, I just don't hear a lot anymore about just individual stocks. There's a lot of videos now on SCHD, VOO, all the ETFs. So I just wondered if that was a trend,
Yeah. If the thing that comes to mind is with so much money, and I guess they can call it dumb money, right? Dumb money going into ETFs. I forget the Warren quote about it, but he alluded to, they call it dumb money. But if you're performing average, like 10% a year, like that's pretty smart. You're not dumb, even though it's called on Wall Street, the dumb money. Right.
Right.
But as far as me, like, I forgot what I was going to say. Something good though. I was going to be something good.
I bet it was going to be awesome.
Ian and SCHD and just wanting that core and not having to. Oh no, that's what it was. The individual stocks. As more and more people keep dumping money into funds, I think that'll create more opportunity for maybe stock pickers, for individual stock investors. Maybe not so much if you're trying to hunt the Mag 7s. Because the fund flows are going to artificially inflate those Mag 7. The more money that comes into VOO, the more that they're going to be forced to up that percentage allocation and buy more Apple and Nvidia and Microsoft. So it's going to be hard with those. But then obviously it's a double-edged sword because when money comes out, then they're going to fall much faster than some other things might. So I think it could give us opportunity for individual stocks. Hopefully that's my thought, at least.
Yeah. Well, I find it interesting that you say it's kind of like a core satellite strategy that you have where your core is the ETFs and then your satellites are, the 15% of the stock, individual stocks. So that's pretty cool. I have something similar, but almost inverted. I have about 35% in ETFs, and then the rest of it's individual stocks. So,
hey, and there's, again, I'll quote my guy Warren, who said there's more than one way to get to financial heaven. And it's, it's a lot of religions, as long as it works for you and you're going to get to where you want to go. That's literally all that matters. And if you sleep well at night.
Well, it does matter to actually have a good time doing it. Right. So, and if I didn't enjoy individual stocks, I wouldn't be in them. So I guess you just got to enjoy it. So we were talking about, performance versus market. And one of the things I share every week is where the portfolio has been for the year. So these are year-to-date percentage changes by week. Okay, does that make sense? So it's not weekly changes. It's the year-to-date every week. So the green line here, and there's a lot of stuff going on here, but the green line is my portfolio, and I don't have this illusion that my portfolio is always going to beat the market, right? If the market is going like crazy and it's going, up really fast, my portfolio is not designed to keep up with that. I've got some stocks in there who aren't going to move up as fast, or I don't have a lot of tech stocks in my portfolio. Conversely, when the market drops like a rock, I don't expect my portfolio to drop as fast either, right? So I'm trying to look for lower volatility, and it helps me sleep at night because, folks are losing, what is this? The Russell 2000 got down to like 17% loss at one point. I was sitting, somewhere around 6%. So I can deal with that. But, this past week, you can see that everything went down, even my portfolio. So my portfolio is still up, but it is just barely up. I'm up like 0.1% year to date. But
it's impressive, Kevin. I mean, seriously, that's a feather in your cap. I would tout that out.
Yeah. So for a short period of time, it's cool. And but I do also track back to when I started this portfolio, which was when I retired in 2021.
Mm-hmm.
And because what I want to do is I want to look at it over the long term to see if what I'm doing is actually making a difference. And so far we are ahead of, and I only compare against the S&P 500 there, because that's like the coup de grace, right? So so far on the long-term basis, we're still ahead of the S&P 500. So if I enjoy it and I'm making a little bit more money than I would get in the S&P 500, why not keep doing it, right?
I agree.
That's where I'm at.
I agree. If I had those results, I'd say, heck yeah, keep doing that. Do what you're doing.
It's a great time, man.
All right, we should get to some of these comments. They're piling up here.
All right, let's get to them. All right, so we've got Shannon.
Yeah,
Shannon's buying some UNH. What do you think about UNH, Russ?
Yeah, I wrote about it, and for me, I know it's a big position for you. I think I don't know enough about it and how things are going to shake out. I think that you're betting on a lot of uncertain outcomes to break their way, I guess, where you have the allegations that may or may not be true. I don't know. There's smoke. Hopefully there's no fire. You got the new CEO. I'm sure that they're going to replace. I don't know what Hemsley's, who his successor is going to be. Hopefully he can steer things in the right direction. Medical costs are rising. They can get that under control. A lot of regulations, headwinds coming. I don't think, and I know people get upset just saying the word like single payer, government run healthcare. I don't think it'll ever happen here, but I don't know. Maybe there'll be a hybrid someday, but there's a lot of people that want it. I don't think they're going to go away. So that's, I guess, a looming specter that's always like creeping in the shadows, like a super villain. It's, and I know they have, again, there's debate if it's true or not. They have the highest denial coverage. I know it was at 32%, and the industry average is 16%. United, though, has said that they approve 90% of all claims. So, but that just tells me that apparently it's not as clear as, when you have one side saying you deny 32% of claims and one side saying, no, we approve 90%. And then also the last coup de grace, I guess, thing that I would be worried about, as I told you when I was in the chat, that if they're found of criminal Medicare fraud, United Health or any company can't participate in the Medicare system or the Medicare program for at least 5 years. And in the last year's annual report, 47% of United Health's revenue was from their Medicare and retirement business segment. So almost half of their revenue is from essentially Medicare. And that would be really crippling, I think, if they couldn't see that coming in for 5 years. But again, that's all we don't know. Maybe it happens, maybe it doesn't, but there's a lot going on with them, I think.
Yeah. So when you get a chance, shoot me the reference on that fraud thing. I actually looked for it and I couldn't find anything. And I'm sure it's correct. I just can't find it. I just want to take a look at it. So, all right. So yeah, I do own a few shares of United Health. It's about 3.8% of the portfolio. So regardless of what happens, even if it goes to zero, it's not a tremendous impact on the portfolio. So that's good. Dude, how did I end up losing you? There you are.
Oh, I don't know.
You're back.
I didn't. It shows you I'm paying attention, right? I'm so used to just seeing you on the screen. I mean, I didn't even, but that's my thing. I don't know about you, but I've learned that one of my faults is like when I see these fallen angels and falling knives in companies that are a name that everybody knows. I said it's kind of like a sailor on shore leave that's attracted to a strip club. That's me when I see Starbucks, Intel, Nike, Disney, United Health. When I see these companies that are way up here and now they're way down here, I'm like, ooh, I should buy that because they're going to go way back up here, but not always. AT&T is kind of breaking that trend. They just waited for me to sell out, and then they started to climb the march upward, But
yeah, so if you'll buy UNH and then sell it, that would be really great for all of us, I think, who own it.
So just because I'm sitting, I'm sitting this one out, don't worry, it'll go up. But honestly, for you and everyone else invested, I hope it works out for UNH.
Yeah. Well, I totally agree with what you're saying. It's, just because a stock is cheap doesn't mean it's a good deal. So that's kind of the way I look at it. But
you're protected. It's not like it's 50% of your portfolio. So
right. Yeah.
It would suck, but it's not going to cripple you.
That's right.
It's not something
it's
you
already
won't
come
financially.
down.
Yeah.
So, all right. So Tony here is buying Costco. What do you think about Costco? Do you own any Costco?
No, I'd love to. I think Ryan Williams calls those your white whales, and that's been for me. I'm the genius though that said it was overvalued when it was around $500 a share.
Right.
But honestly, I have a really hard time justifying it at these just nosebleed valuations,
Right.
and I think it's going to take a long time for you to catch up buying it that high. But again, I could be wrong, and I'd really like to see it. When I look at its historical price to earnings ratio, I think last time I looked, it puts it somewhere around mid 700s is where I'd feel comfortable buying it.
Oh, okay.
But I don't know. The thing's a beast. And it just, speaking of, and Joseph Carlson mentioned that. It's funny you bring up Costco because he said, and my company switched to United Health this year. We used to be on Blue Cross Blue Shield. And in 2025, we switched to United Health. Nobody likes it. There's been a lot of problems with claims. We haven't really had to make a claim, but we've had to find a few new doctors that weren't in network, and nobody's been happy with it from what I've heard. But, is that everybody? No. But most people like me, we enjoy going to Costco. Hey, everybody, we just bought tires last week at Costco and a battery for our car, for our backup car we took to Indy. And it was really good, too. It was like $920 for 4 tires installed. I don't know. That's not too bad. We have an SUV, but we enjoy going to Costco. We look forward to Costco, and I'd love to be a shareholder individually. We have mutual fund exposure, fund exposure. But individually, I don't own it. But we enjoy going to Costco, and that was like Joseph Carlson's thing is most insurance companies, health insurance companies, people don't enjoy doing business with them. It's almost like a necessity that you have to just grin and bear it and bite the bullet. But Costco, Netflix, Disney to some extent, right? Just people enjoy using those products. So,
Yeah.
Didn't mean to bash and dump on Costco or on UNH so much. But.
Yeah. So I don't own Costco. I'm like you. They are perpetually overvalued from my perspective. So I have never owned them. And, if they were to come down, I would consider it. I do like the revenue model. I like, the business model itself. But, the valuation kind of scares me away. So
it's my number one buy if the market crashes this time. And anybody watching, you may see me just sell like 2 or 3 other positions to consolidate. If it becomes what I deem as, a good value or even cheap, I would have no problem taking 3, maybe even 4 positions and just consolidating them all into Costco because it's, obviously, unless they're facing crazy criminal trial, or criminal investigations or something, but,
So we got Gorilla Nurse who bought into Lyondell Basel. Is it Basel or Basel? I don't know.
I say Basel, but,
Basel?
Lyondell Basel. Basil. Maybe I say it like that. I don't know.
Yeah, they should make it easier to pronounce. But anyway, they did raise their dividend 2.2%. So, hopefully that goes well.
Yeah.
Oh, here's a good question. I think this will be fun. Do you guys buy any covered call ETFs? This is like one that comes up most every show, but
I haven't.
Let's come at it.
Yeah, I don't because. And I don't know if he's talking just about like JEPI or JEPQ or SPYI, and now is all the rage. The S&P 500 income is, I've been told GPIQ or GPIX are 2 that are really solid. I think Goldman Sachs runs those, but it just feels to me like they're all just getting their hat in the ring with the covered call ETFs. Obviously, I've bagged and I've trashed and I've dumped on the Yield Max funds.
Right.
I did a video on OMAH. A couple people didn't like it. The Berkshire covered call 15%, but they're giving you a lot of your money back as return of capital. And I know we've talked about this, but sorry, I'm laughing, Kevin, because I'm just thinking like covered call ETFs. What do you think? He's drinking. He's like going to kick back, unplug, go smoke a cigarette. But
maybe I can
cigar,
get my wife Dash to bring me some snacks or something.
Yeah. But a lot of these, because they want to, I think they're preying on retail investors' desire to get rich quick and get a lot of money coming in with very little effort immediately. So they promise you like a 15% yield. And I'll talk about OMAH because I just looked into them. Their last two, or their only two distributions so far, and they don't pay dividends. It drives me nuts when people call them dividends. They're a distribution because they're giving you a mix of their income and return of capital and a few other things mixed in that I'm still learning about. But they're 95.8% was their first return of capital. So that distribution payment they gave you, almost 96% of that was just your own money coming back. And then the next one they did was a little better. I think it was like 87.5%, which is still ridiculous because it means that they're not generating enough income from the premium of the options to meet that 15% target. And it's a 15% target ETF. It's called the Berkshire Select 15, whatever. When you see that 15, that's what they're promising you is a 15% return of 15% yield. But when you're getting your own money back, that's going to erode the net asset value of the fund, the NAV. And you can clearly see it because since that started trading in early March, the net asset value is almost down 2.5%. That's come off it. And that's why all these covered call ETFs, whether it's, S&P 500, TSLY tracking, referencing Tesla, they all underperform it on a total return basis. And companies like some companies don't even pay a dividend like Tesla. And for TSLY to sometimes, I don't know, people tell me it has like a 90% yield or something. I'm like, yeah, but you're getting most of your money back. And if that were true, it would outperform Tesla, which it doesn't. And Tesla doesn't pay a dividend. Plus, you're like with OMAH, you're paying a 0.95% expense ratio, almost 1%. So you guys need to be very careful with these things. And I think it's a phase. I don't know if they'll be like SPACs were, where they're going to just kind of go away, but people swear by JEPI and JEPQ, but I think it kind of limits your downside. And as you've said, Kevin, that anytime you sell a covered call, believe me, I know, you instantly get income, but the trade-off is that you are limiting your upside potential.
Yeah.
I always say the stupidest thing, like I make a joke of it. If you sold, I don't know, say PepsiCo's $130 a share right now, and you just go out and $13,000, you buy 100 shares, you sell a covered call at, I don't know, 150, call it, and you get money for that. Maybe you get $100. If the day after you sold that, PepsiCo realizes, or they find out that some mix of artificial ingredients in the Doritos, the Cool Ranch Doritos, can cure cancer, and it'll help you quit smoking and stop drinking, and you'll lose weight. Wow, PepsiCo just went to $3,000 a share. Well, that sucks for you because you're only getting $150 a share. And so there's a trade-off. There's no free lunch. And with the covered call ETFs, you always have to say, anytime you see a high yield, you got to be skeptical and say, how are they producing this? How am I getting it? And unfortunately, a lot of young investors and new investors, not young age, but young in time spent investing, they just don't think about that, and they get sucked in by that high yield. So, not for me.
Yeah, I think it's good to distinguish between the the yield max funds and covered call ETFs. I think they are distinct, from each other. I am totally against these high yield max funds. I just don't think they are managed well, and I think they distribute your own money back to you, and that's just not what I mean. I can do that with my kids, right? I can give them money and they'll give me less of it back. So it works.
I can have my daughter give me $1 and I'll give her 95 cents back and say, look at all that money you got.
Exactly. Yeah.
Oh, and like, I think you were going to allude, I don't know, put words in your mouth, like JEPI or JEPQ.
Yeah.
I vaguely remember, and I haven't gone deep into those, but I remember reading something about ETNs. Something traded notes. I don't remember what the E stands for, but exchange traded notes. And I you're right. I read exchange traded notes, and something about synthetic covered calls using exchange traded notes or something like that. And I was like, okay, too hard, Pile. I really don't understand what's going on here, how they're generating this. And if I miss out on crazy, super fantastic gains, so be it. But I'm not it's not making sense to me.
Yeah, and there's a lot of complexity to it, but at the end of the day, it's exactly what you said. It is that if you're selling a covered call, you are and why would somebody pay you for a covered call? They pay you for a covered call because you are taking the downside risk for them. They are paying you to take that downside risk, and they get all the upside. Then it's exactly the same with a cash secured put. If you sell a cash secured put, you're taking all the downside and you're getting paid to give them the upside. That's what they're paying you for. That's the value that, those options bring to the table. And so here's my thought on it. If you're in need of current income, funds like JEPI and JEPQ and stuff like that probably aren't a bad deal. But if you're looking at that from a total return perspective, I don't think you're going to be satisfied. I think you're going to want to stay out of those funds. So
that's what I thought. Dude, you're not even going to laugh. I was just scrolling the comments. You're so far back.
Am I really?
You're taking it to a new level.
Wow. I was looking for it to scroll, but I had to actually scroll it. All right, so let's keep going here. We will.
You can pick out some of the. We appreciate you guys sharing the stocks you bought, and I hope that's helpful to you guys in the chat. Seriously, I love seeing what everyone's buying, but yeah, Kevin's worse than me with because I always tell them I'd like to spend 5 minutes on every single comment, and
but you spend 5 minutes all by yourself. So then when I spend 5 minutes too, it takes a long time. Yeah. All right. So Janice says ETFs are just a great way to start investing. I think that's exactly right. I think that is right on the money.
It's people that don't know how to invest or they don't care to learn. Dude, my wife understands it's important. She has no interest in learning about individual companies, learning how to read financial statements. So she's busy. She's a mom, but she still wants to invest. So we got her in VTI almost a year and a half ago, just as kind of a little dip your toe. We do $50 every Friday. I love it. It's my Friday treat. I kind of forget about it. And then all of a sudden I'm working, doing whatever, and I hear the alert. I'm listening to a podcast, and then I see it says just bought $50 of VTI through Fidelity, because you can do fractional ETFs there. But yeah, it's a great way. 0.03% expense ratio on VTI. Most of the Vanguard funds, VOO is the same. That's $3 on every $10,000 invested annually. My God, people, the dividend yield is probably 1.5%, somewhere in that ballpark. Your dividends are going to pay for the expense fees that Vanguard is collecting, which is it's negligible at that point. And it's just such an easy button. And as we discussed, trying to beat the market over an extended period of time is incredibly difficult for professional fund managers. So somebody that's like my wife, a busy mom, dude, just being able to participate in the market for 0.03% a year for every, no, I was going to say for every 10,000, but no, 0.03%. It's $3 for every 10,000 is how that works out. So you're right, gotcha. Janice. Well said.
Yeah. That's a great thing. Here, I think it's a pretty interesting comment. So many don't know what's in the ETF they are buying. They think it's diversified and it's all tech. So, that's probably true.
Yeah,
right?
Well, right. People say that about VTI and VOO, the S&P 500, right? Yeah. Some truth to it. But hey, that's just the flavor. That's what's killing it. That's what's making all the money right now, man. And if whatever comes next, I don't know, that rises to the top. The cream that rises to the top, like Macho Man said, that's what it's going to be at the top then. So it's just always up and to the right because of that. But yeah, well, that's a fair point.
Yeah. Let's see. Here's my buddy Pat, all the way from Minnesota. He says, or maybe Upper Michigan, close to Minnesota. Now that I'm old, I like ETFs. Like Russ said, it's somewhat safer. I'm looking at a 70-30 split ETF single stock. So he's pretty close to you, actually.
Yeah, and it may change. I'm still working on getting there. I should have said that too. We're, I think, still at like 75-25, but it'll get there over time. But that's my target. It's 85-15. Idiot proof it. So
yeah, there you go.
Still have some individual stock picking fun.
Yeah, that's right.
It's a way to be responsible. It's like somebody that's responsible, and then on Saturday and Sunday they just let loose and go crazy hog wild. So that's what we're doing here.
So here's a good question, because I get this I get this a lot, actually. What do you think about Kroger? I mean, for me, Kroger is it's a great company. I think it's going to go places, and I think at the right price it could be worthwhile. I don't see it as I don't have it in my portfolio because it just doesn't rise to the level of some of the other stocks that I see.
I have not looked at it in a minute. It looks solid. They're not going anywhere. It's I just scanned through it a little bit. It's definitely going to be one of your recession-proof companies. Mm-hmm. But one thing interesting I did read, I subscribe to Retail Dive. It's just like news bits every day of certain industries. Like they have healthcare dive and trucking dive. That's one of the ones I like. But Kroger, I saw, I think if somebody can correct me if I'm wrong, they've stopped their grocery shipping business, kind of like Walmart and Amazon have done. So I think I saw that they're wrapping that up. They're suspending it. But then, of course, I don't know when that takes effect, because when we were in Indianapolis, I was at a roundabout and I saw a Kroger delivery truck, like food delivery truck. So maybe it's the end of the year. I didn't read I just saw the headline and, it was a bad boy. I didn't go deep and read the whole article. So.
Yeah, so I think McVeigh is asking you this. Do you invest? I think it OBDC, is that Old Dominion?
No, Old Dominion is ODFL. This is Blue Owl.
That's right.
And I think Ryan invests in Blue Owl. I think he has for a while.
Blue Owl Capital.
My flavor of BDCs is Ares Capital, ARCC, and Main Street Capital, MAIN. I wasn't big on those. You guys should do yourself a favor. You can listen to the audiobook. Stephen Bavaria is the author. He has a book called The Income Factory, and that really kind of changed my perception on those. And I said, you know what, I'm going to get a couple of these into my portfolio. And the idea behind them is you have to understand you're not buying them for capital appreciation. You're buying them to receive more income and then turn right around and reinvest that income into more shares, which will, it's the whole income factory. They'll give you more money. So then you buy more shares and just keep repeating and repeating. And they're supposed to be stable enough that you just want the share price to be just flat. Maybe it'll go up a little bit. You don't really want, you're not concerned with that primarily. You're concerned with the income that it spits out at you. So, but Income Factory by Stephen Bavaria. And I'm sure that would fit right in there, OBDC, but I just don't invest in those guys.
Yeah, I did an entire video on the Income Factory.
Ooh,
by Stephen Bavaria. It's been a minute. It's been probably a year. We lived here in Alabama at the time, so it hadn't been that long, but no more than 2 years ago. And I think it's yeah. So there's pieces of it that I like, right? There's this idea of saying, hey, there's a return that I want, and I'm going to go find the instruments, and if I can get that return almost guaranteed, like in dividends or in some kind of preferred shares or closed-end funds or something like that gives me the return that I'm looking for, then, I should just set it and forget it. I should just buy it. And if it's a consistent 8, 9, 10% per year, just get it and go. And I'm going to miss the 20% and I'm going to miss the down 20%, but it's going to give me, so I like some aspects of that, but I think it's really tough for investors not to focus on equity gains. So if you're just looking for income, I mean, somebody that my age, I could certainly, I could say, hey, that's a great idea, right? Because if you're looking for income and you're just trying to get a certain amount of growth every year and you're good with that, I think that's fine. But if you're 20 years old, if you're 25 years old, I don't think you're doing yourself a favor by doing that. I think you're missing out on some growth. So that's just my take.
I have done incredibly well with Main Street Capital I have I wonder if I could share this. I think I can share stuff, right?
Should be able to.
Present. Let's see. Where are we going? I gotta remember how to do this. Oh, here we go. I think this will do it. So this is Main Street Capital for me. You can see that, right, Kev?
I can't. Hold on. Let me see if there is something that I've got to switch here. Guests.
Yeah, I think you might have to toggle. Yeah, because I got the feed on there too. But anyway, so while he's figuring that out, I haven't updated this since November of last year. And I have 150 shares of Main Street Capital. And it was my average share price that I bought was $37, which was kind of low. So it was at a good point when I bought it initially. But I've received back in November on those 150 shares over $1,100 in dividends. And I adjusted my share price. I know Kevin said sometimes he doesn't like to do that, but my average share price with that in November was $29.94. They do a lot of special dividends, and they've increased it. So I'm probably somewhere, I would have to guess around, oh, there you go. So I put at the top so I can remember, and that 11/27/24 was the last time I did this. So there's a few stocks I keep this chart, and I do this just to, it's all hypothetical. It's not a cold hard number, but anytime I receive a dividend or an option income, I just subtract that from the total cost, and that puts me under $30 for them. So my adjusted yield on cost is 10%. So anyway, the point of that is that, yeah, it took a minute to realize that I'm buying it for income and not just for capital appreciation, which Maine at one time did go up to over $60 a share, and I bought in at 37. So, but yeah, anyway, so just know what they're buying, know what they hold, kind of like an ETF. You should always look under the hood and, know the methodology to the madness, I guess. How are they generating the income? And I guess it goes for any business, not just ETFs or BDCs, business development companies. But, if you're buying PepsiCo, you want to know, how is PepsiCo generating revenue? You should be able to tell your 5-year-old niece or your 98-year-old grandma, and they should be able to understand you. And if you can't do that, then I don't think you understand how the business makes money, and you shouldn't invest in them.
You heard it first here.
Sounds good. I don't know. It sounds like it's reasonable.
That's right, man. I think that's right. So my buddy Michael Swami always helps me out, right? So instead of exchange traded notes, it's exchange linked notes.
There you go. Thank you.
Yeah. So
ELNs, that's what they were.
Yeah. He's looking out for me all the time.
Thank you for clearing that up. 28 minutes later, I'm sure. We're two peas
what
in
are
a
you trying
pod,
to say?
I'm just like you. You're just a little bit worse. So,
in your opinion, right?
Yeah, you're smart and I'm right, I think they say.
Yeah, that's right. All right. Have either of you owned any offshore oil service company shares? I have not.
No, not.
Sorry,
I know
Matt.
I think, Matt, you're trying to find a backdoor way into your Brazilian. I think there's a Brazilian company that Matt always brings up, and I think they're partially or mostly owned by the Brazilian government, or Petrobras Brasileiro or something like that. PB something, Matt. Something like that, but I have not.
Gotcha. We got several people here who are saying good morning. So they must be Sam. Somewhere else in the world.
Yes, Sam. She's in down in I think Kiwi land. I don't know. I was trying to think of another nickname for New Zealand, but she's either in New Zealand or Australia. Okay. So,
and then we got Korean Cardboard, who's I'm assuming in Korea. So that,
and he's from Chicago.
It might be a terrible assumption, but let's see. So here's Michelle. Michelle says, my mom's a bakery manager for Kroger. Her store is closing and she's being sent 30 minutes away. And they're closing 3 to 4 other local stores around me. I'm with Ray in Houston. So
interesting.
Yeah. So
I don't think Kroger's ever going to go away. I know around here in Chicago, they own Mariano's, and they were trying to merge. what was that? Yeah, the merger didn't go through. They were trying to merge with Albertsons, ticker ACI, which Albertsons around here owns Jewel Osco, as some older people fondly called it, the Jewels. But I gotta love people that are old. When you're the way they called it. Instead of going to Jewel Osco, I gotta go to Jewels and get some eggs. But yeah, so the government nixed that, and it's interesting. But as Kroger had said, and I think it should have went through, because I think once they combined, they still would have not even been close to being toward Amazon or Walmart. So yeah, I don't think that. But anyway, yeah, that's a good point. That's closing stores. So yeah, that stinks, man. Stinks for your mom.
Here's an interesting thought here. While Ron here was in the wealth accumulation phase, he was 100% in funds. But after he early retired, he found the need to get into stocks to increase his income. So that's kind of
someday I'm going to get Ron on the channel. He's a name that a lot of you might know. He talks to the boys at Dividend Talk. He's retired. He travels abroad, lives abroad. He's from here, born and raised in the States. But him and his I don't want to give away too much information, Ron. I don't know how much you want. We'll just say you travel abroad, and leave it at that. But he's talking the talk and awesome. Living off dividends. So yeah,
great stuff, man. Hey, and look who's joined us, our buddy Ryan. Welcome.
When did you put that, Ryan? Probably 38 minutes ago now. Huh?
Yeah. No, we're only 9 minutes behind.
Are we? Bad. Okay, I haven't moved my chat then.
We are not bad. Let's see.
Okay, I like Kevin's. When you get to Kevin Williams's, that's cool. I love this question. Just you'll get there, but or maybe you passed it. He said, "Isn't Costco in VTI?" Kevin, you're right. There's almost 4,000 stocks in VTI, and as I tell my kids, when you buy something like VTI, you're buying a basket. You're buying an itty bitty, teeny tiny little sliver of almost 4,000 companies now. Some of those slivers are bigger than others. Costco's going to be a little bit bigger sliver, but yeah. And that's why I say I still own Costco, but it's just not individually, which one day I really do want to. But Ryan, I've been thinking about that. The Berkshire, I think I'm going to do it. Ryan and I are talking about meeting up at next May in Omaha for the Berkshire. It'll be the first one without Warren at the helm, on stage and as CEO. But he's going to be there on the floor with the other directors. And I don't know. I need to experience it. At least I can say I went there when he was alive and in the building. Please, Warren, make sure you make it another 12 months. But yeah, you have to own a share of Berkshire to be able to get 2 passes. And from what I've heard on podcasts is that there's so many people that have more than 1 pass, because probably most people's wives don't want to go, and spouses and significant others. So there's usually they say there's just some bars in Omaha for that weekend. There's just a basket full of extra passes. So really, like, anyone can go. But yeah, I'm still going to own that share outright. I don't know how I got there from you asking if Costco's in VTI, but welcome to the madness that goes on in my head. It's the shiny
I think this is appropriate to show right now, which is are people saying good morning because Russ's answer took so long?
Well, if there's a best answer of the night, you win that. So, Hey, and you laugh, but we laugh. But I tell everyone I've been using AI to help me be more concise, because when I write my newsletter or things, I just get very just too wordy. Like I'll repeat myself and be redundant, and it'll take my words and just polish it and be like, okay, we've taken 8 pages and put it down into 1.5. And I read it and I'm like, oh yeah, hey, it said everything I said in 8 pages in 1.5. That's pretty slick. So
yeah, I use that too, like on social media and stuff for posts on different groups that I'm in. Sometimes it'll give me the option for AI to kind of look at my response, and I'll do that, and it sounds so much better.
It's beautiful, and I know some people are still against it. I don't know if they're Luddites. The Luddites were people that didn't like technological advances back in the day and would try and break machinery and things to keep it from coming in. But I think if you're saying, and I've told my kids, the way I use AI, it's an assistant. It's like a research assistant. It helps me, I will do brain dumps into it, just vomit at it just every thought of what I want to say, and then tell it like in in my own unique voice with what I told you, rewrite this so it's more concise, it flows better, and it will do that. So it's all my thoughts. It's just like working with a really nice assistant who says, yeah, I can polish up what you wanted to say there. So it's a little bit easier for everyone to deal with.
So Ryan's got a good question here. And by the way, I'm only 3 minutes behind now.
Good.
He's got a great question. When do you have to be a shareholder of Berkshire to be invited to the meeting? And let me add something to that. Is it either A or B shares or either?
No, it's B. It's either. If it was the A shares, that would be a pretty neat trick, because that's what are they? I don't even know. They're probably like $700,000-800,000 now dollars a share, because they've never split. And it's probably somewhere 700 to 800. I don't know. But Ryan, I don't know. That's a good question. Maybe I should just get it over with and just buy the share now. But that's something that I'm gonna have to find out. Yeah,
Berkshire is $591,930.
How much was it?
$591,930.
Yeah, and what's the A?
$591,930 per share. These are the A shares.
Yeah, okay, that makes sense. I could have sworn it was higher, but yeah. Anyway, yeah, that's there's not a lot. There's like 1 million some shares outstanding, which is just ridiculously low.
Oh, it's come down a lot since May 5th. It was $809,000 a share.
Yeah, I was gonna say I could have swore I remembered seeing like almost 800,000. So
wait a minute, hold on a second.
I don't know, Kevin. Are you sure?
I was in this app and but now it's saying $754,505.
I'll look on Simple.
Oh, I know what it is. I was looking at the average. What is this called? The analyst. The average analyst value. What they think the company's worth. They think the company's worth $591,000.
Oh, that's interesting.
The actual cost is $754. So
and
they think there's a 23% downside.
It very well could be. But it's funny as you said that, and that's another teachable moment, is that a lot of new investors will just look at the price of a stock. And I've had people say, how can you say this is undervalued at $400? It's so much money. I'm like, no, it's not. You have to look at the shares outstanding. There's a lot of things. You can't just look at the price. So if Berkshire right now, if Berkshire tomorrow, if there wasn't anything crazy with the company, if it dropped to $250,000 a share, boy, I don't know what I would try and come up with $250,000 to just, I don't know, liquidate almost everything just to go into one share of the A, But yeah, it would be really undervalued at $250,000 a share. So.
Yeah. So Ryan wants to know if I can pick up a few A shares.
Yeah, he can
I
be
could probably do 2. I could do 2, and then I would be done. That would be my. I wouldn't have to do much else with my portfolio. So, yeah. So yeah, Michael, it was my fault. I was looking at the analysts' estimates for the stock, not the actual price. My bad. Michael says he'd be a buyer under 510. What do you think, Russ? Think would you be there with him?
I would definitely consider it, man. And that's why when I heard you say 500, I was like 500,000. I was starting to think that might be a good territory to buy. And that would be interesting too, because I don't know if you can buy fractionals. I don't know how that would work.
I don't know. And if that would work at the door.
Oh, yeah. So David, my guy David,
he says that they say you need to show share ownership from a statement at the door. Okay. So it could be the day before, I guess. Well, I guess you got to have a statement. So, but you can print those on demand a lot, Yeah,
maybe I'll. So I was reading Cody's. I was like, "What is our Citizen of the Year (COTY) about the?" Disqualified any 500. I don't, dude. I think you're. I met up with Cody at the NASCAR street race in Chicago. He's in Chicago too. So I met up with him last year, and he has a YouTube channel. But Yeah, I don't know. I don't remember if you're into that racing. I'm not into it that much. I go for the people, the atmosphere, have a few adult beverages, it's been reported. But yeah, well, thank you for sharing that.
3 of the top 12 cars got DQ'd at the Indy 500, and Russ was there, and he doesn't even know.
Yeah, I was by the Snake Pit. It's like a EDM concert, and it's wild that you don't even know there's a race going on when you're there.
So Michael says here, we better start our GoFundMe accounts now. So
I would feel terrible. Could you imagine if I started a GoFundMe as to help this investor get to a full A share of Berkshire, and then there's kids with cancer and somebody's home got burned down in a fire on either side of me. You'd be like, you ass, come on. It would be a bad look.
Okay, so Michael's working at in Indy right now, and he got sent home because the hotel prices back to Evansville for the weekend. Oh, okay, yeah. So I'm sure it was pretty expensive to stay there.
Yeah, I don't know. Like I said, I slept in a tent in a backyard that was about 28 minutes southeast of the city. So I don't know about hotels in Indy right now.
Yeah, I'm getting too old for that, man. I need a bed.
An air mattress. We got a queen size blow up air mattress.
There you go.
It's a good in between,
Yeah. And Cody says, if you're not cheating, you're not trying.
Yeah, that's some truth to that.
All right, my buddy Steve wants us to go through the news super fast. So let me see here.
Oh, yeah, the good old
I figured out why yours wasn't showing up, and it's because I was displaying. Even though it wasn't on the screen, I had it in the background. So once I killed that, then yours was there, and I just added it to the screen. So let's see here. There we go. Here's the news here. I'll take Steve off. So let me make this a little bit bigger. Is that better?
Yeah, I think it looks good.
All right. So, and then this is the news he's talking about, right? The latest?
Yeah.
So we've got LyondellBasell. They increased their dividend by 2.2%. We got Unum, which is a life insurance company, boosted their payout by 9.5%. So that's nice. Pretty cool. Got Flowers. That's like a grocery store, right? Or
no, they make Dave's Killer Bread. I think they got Tasty Cake. So they got
stuff like a bakery kind of thing.
Mm-hmm. Yeah, baked goods. So I think they're a leading baked goods maker. That's what the first sentence says.
The leading baked goods maker faces whatever. But anyway, it's 3.1%.
And Bubba's Bagels. That's what they also got. Bubba's Bagels.
Never
look
heard
at that. I didn't even read to people. I just remember. Mine like a wet cloth. Some stuff stays, most of it goes.
Helmerich and Payne, they actually decreased them from borderline to unsafe.
Never heard of them.
Yeah, so nor have I. Then the Universal, which is in the tobacco, they're actually the tobacco grower, nudges payout by 1.2%. They have an interesting strategy. If it pays off, it'll be great. If it doesn't, it will be awful for them, I think.
It's an Ian Lopuk pick. First time I heard of them was back in the day. Yeah, from Ian. I think he still owns them.
Okay. And then we have Medtronic. So this is May 21st, so we're almost back. Medtronic raised their dividend by a whopping 1.4%.
Yeah, it's kind of been, if you can just see that little down the bars, that's kind of been par for the course as of late.
Penny at a time. Yeah. And it's a shame because they really have some cool products, and I'd like to see them do better, but I just don't know if their management team is up to it.
Yeah,
they like to. Yeah, they got all kinds of not blood alcohol, but blood sugar testing equipment and stuff like that. That's really cool. But it seems like to me, and I could be all wrong here, and normally I am, but it seems like the management team at Medtronic is more focused on glamour and glitz than they are about the actual product itself and growing the business. So I owned them for a little while and listened to a few of their earnings calls. And after all of these gymnastics that they did in the earnings calls to try to make it sound really cool, I was like, I think I'm done with these guys.
Yeah, and you know what's funny about that, Kev? It shows that their 48th consecutive year of payout growth. I bet you that they're just trying to hit dividend king status, because then you get in certain funds, and it reminds me of not saying that's but there's some companies that have done that. They just slow the dividend down growth to a trickle to hit dividend king status, and then you get some like company by me. I think Dover might have been one of them, DOV, where they'll do like a dividend increase of less than 1% a year, and it's like, all right, I guess, because then people are like, whoa, Dover, they got 69 years or whatever of dividend increases. And then you look, and the last 10 years have been like 1%. It's like, yeah. Great. Good for you guys,
Yeah. Okay. And then we'll kind of flow through this May 20th. WP Carey, they refreshed their outlook. Doesn't look like they changed anything. And then now Northrop Grumman is a company that I'm really looking hard at. They have grown their dividend by 12% this year. It's the 22nd straight year. I'm really seeing some things from Northrop Grumman that I like. So
same. And I could see myself going into them as opposed to Lockheed Martin, which I've held for a bit.
Exactly.
So
that's they're on my list for potential money next time. And I think that's probably far enough that we're back to May 19th now. But then my buddy Ryan here. So, well, first of all, let's again, Michael's helping me out here. I said it's a life insurance company. It is a disability insurance company, which, interestingly enough, is a very profitable business to be in. So, because, for various reasons, we won't get in there. I don't want to take the rest of the night to explain it, but it's very profitable. So, Ryan wants to know, where is MDT's payout ratio? Do you happen to know off the top of your head?
I do not know. No.
Nor do
I think it was low. It's usually
51%.
Low.
Yeah, so it's around, let's see what the history is. Yeah, so it's in the, right at 50% on average for the last 5 years or so. So it's not bad. Yeah. But let's just for kicks, let's go to this Northrop Grumman so people can see what we're talking about. So first of all, their dividend safety rating is a 90. They've got a dividend yield of 1.96. But check this out. Check this dividend growth of the last 5 years, 9.3%, 12% in the latest year. Look at that dividend growth chart. It is amazing. And then take a look at, this is the other thing that I like to look at, which is the earnings payout ratio. See how flat that is? So with their dividend going up so much and their earnings payout ratio is flat, that means that their business is paying for those dividends rather than, eating up some of the capital. So love it. Yeah,
they're just solid. And they've looked like they're in on a contract for the F-35s. I forget what it is now. It escapes me, but Lockheed Martin didn't meet some of the Navy's requirements, so they got dropped out, and it's between Northrop and Boeing. So that's and Lockheed, I think, has been let's see what their ratio was.
Around 45, it looks like.
Go up a little bit to their increases, because I think they're so they've at least come down. It's a little bit higher. But if you go up to their dividend growth, because I think it's slowed down, and that's one thing that caught my attention, is it's their last 10, 8, last 5, 7, 2, and the last was 4, 8. So that's kind of like, okay, I mean, it's still good, but it makes you think, well, what's the deal? That's one of many things you look at. There's no one exact metric people, and that's one thing Charlie Munger used to talk about with like stuff like the capital asset pricing model. People want to plug in numbers and get one nice clean number to like 4 decimal places, and he would say that it's just investing doesn't work like that. There's ranges of things, and as much as you can come up with the quantitative, meaning the numbers side of thing, fundamental analysis, there's also qualitative things that don't show up in a spreadsheet that you also kind of have to get right. And it's a tough game to get both of those things right. And that's why they know, and this is something I'm learning, that not every investment that you make is a success. You will have failures. It's guaranteed you will have investment failures. And for someone like me, I'm still learning, I guess, because when I would have failures, instead of selling and realizing it's a failure, I would just dump more money in. Like, it's down. Okay, dump more. Now it's down again. All right, I'll buy more, and just keep doing that.
Yeah.
And
exactly.
It's like, no, just take the money, put it into something else, because there's a better idea out there that probably should be getting that capital.
Yeah. So then Bernard here is starting a new long-term position in Main Street Capital. So,
well, some think it's overvalued now, but I know Brian Bollinger from Simply Safe Dividends did a video. I would say watch that, Bernard. I don't know how many of you guys know Simply Safe Dividends has a channel, Brian Bollinger, and he did one on Main Street. I was maybe 3-4 months ago, why he's not buying. A lot of compelling reasons, and it almost made me think twice about maybe I should sell too, but I didn't. I'm going to keep holding, but it's definitely information that might be of interest to you, Bernard.
Yeah. And it's not a bad time to start a small, maybe entry position, but I do think that it is on the high side of price. So
that's a great point too, Kevin. I mean, I find that I pay attention to what I pay for more than like if I wanted to look at Medtronic or Northrop Grumman even,
right.
I'm like, all right, I'll look into them. And then something catches my attention. I'm like, all right, I'll next week or in the weekend, I'll look into them. But I mean, dude, as soon as I buy something, then I'm just laser focused and I'm reading, I'm listening, I got money. So it really, for me, flips that switch when you actually get money in there. And I don't know if you're still watching, Ryan, but I did that with Clear Secure, ticker YOU. It was only 10 shares I bought, but once I bought, I paid attention more. I listened to I think like 3-4 earnings calls in a row. I looked through a couple more annual reports. I consumed more information of the company because I actually had, that was a minute fraction of our net worth, but I actually had real money in the company. So I just thought, I don't think this is for me. I could be wrong, but I decided to sell, and I took a super small gain, and then the bottom fell out and I think it dropped more, but yeah, Bernard, that could be another way to do it too. Pick up a couple shares and start looking into it,
Yeah, it's sometimes this feels more real, right? When you got a few shares in it and it's part of your portfolio. I got to the place where I had done that so much, I ended up with all these shares, all these companies with little tiny pieces of the portfolio.
Oh, so but you wouldn't sell.
Yeah. So I just went through and I got rid of anything that I didn't want to keep. And if I wanted to keep it, my goal was to buy to make it at least 1% of the portfolio. So if I didn't feel comfortable enough with it being 1% of the portfolio, then I needed to do more research and I needed to get out. Right. So that's the way I looked at it. And so that's the way I do it now. If I don't feel comfortable enough to buy 100% or 1% of the portfolio, I don't buy it at all. But for me, that's different than somebody who is maybe early in their career. Right. And so they're dollar cost averaging in. And so I think that's, if you find a stock you like, a company you like, it's probably, the valuation is probably less important if you're dollar cost averaging in, because you're going to, over time, have a reasonable cost basis, in my opinion.
I think that's right. And again, I understand. I know I was on the chat or when you were talking about that, and a few others said, yeah, if you should buy 1% of it. But yeah, it's not for me, but I'm not saying it's wrong, dude. If that works for anybody else, do it. I mean, who am I to say? But for me personally, I'm okay. Like, I'll buy it and then I'll make a decision like I did with Clear Secure and say, yeah, I could be wrong, but I'm not feeling it. It's not for me. I wouldn't want to buy more shares. So I ended up selling and I exited the position. I think I called those, not tester shares. I'll think of it. But yeah, it was basically just like a try on, try
Right,
before you.
right.
Well, I guess that
Try
wouldn't
before
work
you
because
buy.
I bought. It can't be a try before you buy. Oh, exploratory position. That's what I called it.
Or
I called
sample.
it my exploratory position because now I
Okay.
got like Ryan said. Someone said you actually learn a lot more about a company after you own it. So, and I did. I learned a lot more, and I know you're still in it, buddy. I'm rooting. I feel bad every time they drop. I'm like, come on, I want to see these guys pull up for him. But actually, to prove me wrong and to prove everybody else wrong, that usually when I sell, that's when something goes up. But
yeah. All right, buddy. We are an hour and 15 minutes into this thing.
Smokes!
Yeah, and one
of
us has to get up and go to work tomorrow.
Yeah, I will, Ryan. I'll keep my fingers, eyes, and toes crossed for you.
Yeah, Bernard's up to 25 shares.
Oh, well, there you go.
Position. Yeah.
Didn't he just say he was going to start a position?
Yeah.
Oh, Ryan, you know what? And anybody else watching, the We Study Billionaires podcast, they talked to Jim and Abigail Zimmerman. It's a father and daughter team. They're from Lowell Capital Management out of California. And it was a really fun interview. I really enjoyed it. So anybody listening, I highly recommend it. But they talked about being invested in a smaller company, and it would just keep going down. They said they just kept looking at the numbers, saying like, what are we missing? Like so they would just dive deeper into it. The more it kept going down and saying like, their revenue is growing, their product is good. Like, what are we missing? And then he said it caught up. The market realized that they were way undervalued, and they said it took off and it was one of their best performers. So that just shows that you're learning something, Ryan, like looking at the numbers, and you may not be right, but for anybody listening, it's I liked hearing that you focus on the fundamentals of the business and management, and take all those things, and they stuck it out with that one. But it was a good interview.
Awesome.
Oh, of course he listened to it today. So
yeah. Well, anything else for the good of the cause? I know my camera battery is flashing at me.
All right. Well, no, Michael, I can't. This is he wants to know if I was going to play Pee Wee. So we'll just in memory, he doesn't have the file.
In your mind.
Yeah, you can go to YouTube and do if you really need that. Just go to YouTube, put Pee Wee outro music or whatever theme song. That's where I stole it from anyway.
Yeah,
I keep waiting to wake up and say like getting a cease and desist, like you have to stop playing this. But
I got that. I used the Andy Griffith Show.
Oh, did you?
Yeah, outro. And I only put it on there one time, and they came back and they said, no, this is copyrighted. We can't, because I had it. I changed it over to monetize, right? And they said, no, you can't monetize this. Somebody else has already monetized that thing. So it didn't take long at all. They were on it. So
well, I guess I got lucky because so far I haven't heard a peep. So
well, maybe nobody's monetizing it except you. So
yeah,
there you
except
go.
me technically. So
awesome.
Yep.
All right, fantastic, man. I appreciate you joining me. It's
fun, man. We'll do it again.
Yeah. It is a lot more fun, I think, to do these live streams with somebody else. Because I get tired of hearing myself talk. Much less everybody else. So, all right, man.
Yeah, and all of you, thank you for tuning in. Really, thank you so much.
Sounds good. And so thank you guys for joining us, and hope you have a great short week of investing. And we'll see you on the next one.
See ya.